Hello and welcome to the first lecture of this new section on corporate finance in this course, Finance and Accounting Fundamentals. In this particular section, we will give you some good idea of corporate finance, and there we will talk of three things, and one of them is capital budgeting. That's what we will do in this lecture. So, how do you think you can? What are these things? What is capital budgeting? What is net present value? What are IRR? And what is payback period? So, let's take a look at each of this in a little more detail. So, the capital budgeting is the process where by which the businesses evaluate and plan a significant long-term investment such as uh, acquiring new machinery, launching new products, or expanding operation. It helps businesses decide whether a to undertake a particular project based on its potential to generate future cash flows and profit. You want to put up a new plant. Should you go about doing that and that require $1 million of investment? And what value will it produce in future? Based on that, you can make a decision, and this entire thing is called capital budgeting. The goal of capital budgeting is to maximize a company's overall value by selecting those projects that provide the best return on investment individually and combined. So that is what capital budgeting is. Now, what are the key capital budgeting techniques? There are three that we will talk about here. The first one is NPV, that measures the dollar amount of value created or lost by a project. You invest that $1 million. What is the value it will generate in certain terms today based on the future that you will have? Now, second is IRR, measures the percentage return on investment of what that $1 million you're making. And third is the payback period, that measure how quickly that initial investment of $1 million will be recovered. Now, these techniques help businesses like you to make informed decisions by comparing the potential profitability and risk of various projects. So, if you have 10 projects, you can calculate, you can choose one of them and say, okay, I want to decide on NPVs. You calculate NPV for each one of them and take up those that make sense to you. So, what is NPV? Now, NPV is the different is a difference between the present value of the cash flows and the over a period of time. Present value of the cash inflows and outflows over a period of time. Now, here you see there is CT, cash flow at time T, let's say 1, 2, 3, 4, 5 years. So you'll have five C's. Then there's a discount rate R, and there's initial investment I0, C0. So NPV is equal to sigma of all the cash flows in future discounted by the rate R minus the initial investment. So it takes into account the time value of money, which means that the future cash flows are discounted to the present value, and you figure out what is the value of all the future positive cash inflows versus the cash outflow you have today or maybe in future also, and what is the net present value of that. Now, what does this mean? How is NPV interpreted? If the NPV is positive, the investment is expected to generate more value than it costs. You have C0 and all those CTs have generated more, so it is expected to generate more value than the cost. And that makes it a favorable decision. A negative NPV suggests a project may lose value. That means you will not get enough money in future to pay for your current investment. So that's the interpretation of NPV. Let's look at IRR. That IRR is the discount rate at which the NPV of investment becomes zero. So it's a related to NPV. So you have all those data calculated. You don't have, so you have the C's, you have the C zeros, and then you kind of use an R assumedly, and then you iterate and see at what rate of return does NPV become zero. So it is, in other words, the rate of return that makes a present value of cash inflows of cash flow, future value of cash flows equal to the initial investment. So break even. So at what rate of return is the future value of cash flows equal to the current value of investment. Now, how do you interpret this? If the IRR is greater than the company's hurdle rate or required rate, now you're investing that $1 million and you have a minimum hurdle rate of, let's say, 15%, you will see whether the project is generating an IRR that is higher and lower. If in IRR is higher than that hurdle rate, the project is considered attractive, and if it is lower, then the project may not be worth pursuing. Now, in relation to NPV, IR is the rate that makes NPV equal to 0, while NPV provides the dollar value, IRR gives the percentage return on the investment. So, this is another way of looking at it. Then there is payback period. Now, the payback period is the amount of time it takes for investment to pay back its initial cost. And it is the period needed to recover the cost from the future cash flows. And there you can calculate the initial investment divided by the annual cash flows discounted, which is not written here, but a discounted cash flows is better. And a shorter payback period is generally preferred as it indicates faster recovery of investment. However, this does not consider the time value of money or cash flow beyond the payback period, making it less comprehensive than NPV or IRR. Now, so let's summarize here the net. How do these help you select the capital projects? Now, NPV measures the dollar amount of value created or lost by a project. IRR measures the percentage return on investment, and payback period measures how quickly the initial investment is recovered. Now, these techniques, as we have seen, help you as a business to make informed decisions by comparing the potential profitability and risk of various projects and prioritizing and doing your capital budgeting optimally. So what do we do next? So in the next one, we will look at financing in terms of capital structure of a company through debt or equity financing, and that we'll talk about cost of capital. So thank you so much for watching this first lecture on corporate finance. I hope you're continuing to learn new things, continuing to enjoy, and I do look forward to see you again in the next lecture. Please feel free to message me if you have any questions. I'll be happy to answer your questions, and do download the PDF file to take a look at all those formula and understand them well.